This video is sponsored by 21 Shares. More about them in just a few minutes. The media has been abuzz all month about a subprime auto lender down in Texas that simply vanished earlier in September. Tricolor went from lending to some of the lowest quality borrowers to Chapter 7 liquidation and shutting down operations, leaving a lot of the biggest banks in the world on the hook for hundreds of millions of dollars in losses. But this isn't really about those 100 millions. It's about the way in which the entire system prices many trillions more and the key to all of it. Now, you may not know this, but correlation is the most important variable in all of finance, linking bond pricing all over the entire system. But we can't really see correlation. It's one gigantic assumption upon which so much of the entire global financial architecture really depends. Through liquidation and maybe even fraud investigations at Tricolor, it just might open a window into this riskiest part of the credit markets and then shed some badly needed light on default correlations, which could then go on and further illuminate a whole hell of a lot more for the entire system. So combine that with credit markets that, as a whole, are starting to rethink everything in the wake of the forgot how to grow economy, more forcefully forcing them to. A little bit of daylight from Tricolor might lead to another lumpy reevaluation of systemic correlation. And if so, the chances for uncomfortable bumpiness across money and finance, those necessarily go way up. I say another because that's what started to happen back in April. Tariffs were the catalyst, sure, but it was really about the system confronting the fragility of the forgot how to grow environment for the first time and understanding how that could lead to a repricing across trillions upon trillions of dollars. Tricolor may have unleashed the search for correlation. Now, Tricolor itself, it's less important to the story overall, but it's what has renewed some focus on the credit market segment, so we'll give it some background here. In late August, Fifth Third Bank makes a filing that acknowledges some irregularities in a $200 million asset-backed finance loan, we're going to come back to that term quite a lot, that was made to Tricolor, and says the bank is likely on the hook for $170 to $200 million in losses. Already, that's a huge red flag because how do you lose that much, if not the entire principal? That's where the allegations of fraud came in. Early in September saw federal regulators and even the Justice Department launch investigations. And other big-name banks like JP Morgan and Barclays, they issued statements saying they're caught up in this too, though we still have very little information. On September 4th, Tricolor basically closes its doors on dealership operations before 6 days later, on September 10th, shocking the entire industry by filing for Chapter 7 bankruptcy, straight up liquidation, nothing in between, no negotiations. The whole thing has been a complete mess because apparently Tricolor, when it totally shut down, it meant there are no employees left. There are tons of loans outstanding, some 100,000, with no one to service them. So the bankruptcy court is trying to work through its trustee to gain control over the loans and get them back to normal status. And while all that's bad enough, what this liquidation procedure really might do, as I said in the intro, is shed some light on one segment of the shadow credit markets, yes, another shadow bank, and if what they find when doing so, what they find in the dark corners of that area is more than what the entire system is expecting and pricing, the consequences could reverberate far and wide. Already the news is big investors are bracing for losses. Here's how Bloomberg described it a week ago. The sudden collapse of Tricolor, which focused on lending to individuals with little to no credit history, has ensnared some of Wall Street's biggest players. Banks including JP Morgan Chase and Barclays are bracing for hundreds of millions of dollars in losses, while investors who piled into asset-backed bonds, there's that term again, sold by the company as recently as June, have seen the prices of the securities plunge. But that's not the most concerning part. The most relevant piece of this, the relevant insight, is in what it might tell us about correlation, the biggest financial variable there is. The world's credit markets aren't just U.S. treasuries and straight-up corporate bonds. They are filled with ABS-like securitizations. Before we get back to the rest of our video, I want to tell you about our sponsor, 21 Shares. Here's the reality. A lot of people are interested in crypto, but they want a way in that is straightforward and reliable. That's where 21 Shares comes in. They've taken the core idea of crypto, open access, borderless innovation, long-term potential, and they made it practical. With their ETFs, you can hold Bitcoin or Ethereum in the same account you already use for stocks and bonds. No extra hurdles, no complicated setups, just simple, transparent access built for everyday investors. This isn't about chasing hype. It's about being part of the system that's reshaping money and finance in a way that feels sustainable and more secure. With over $11 billion under management across 50 plus products worldwide, 21 Shares has already proven they're committed to creating reliable ways to access digital assets. So if you care about positioning yourself for the future while keeping things simple and more secure, this is worth paying attention to. Check out 21shares.com and subscribe to their free newsletter. You'll get insights, updates, and a front row seat to the future of investing. This content is sponsored by 21 Shares, but please keep in mind, investing always entails risk, and their products may not be available in every jurisdiction. So please consult a licensed financial advisor before making any investment decisions. These things are all over the credit markets, and they're issued by primarily these shadow banks and investment funds that we're talking about. The very first one came up in 1985 by a company called Sperry that was looking for a way to finance computer equipment leases. Securitization took off for what should be obvious reasons. Securitization takes otherwise illiquid loans, packages them together to create liquid financial assets that can be bought and sold regularly, which means they can be used as collateral and repo. Those loans can be anything from autos to credit cards. I mean, if you've ever used a credit card, and who hasn't, it's not a bank that provides the funds for the revolving line. It's almost certainly an offshore trust that is funded by issuing ABS bonds, and the funds for that come through the repo market. And while most often it's mortgages that go through securitizations, I mean, that's where MBS bonds come from. They're called mortgage-backed securities. What it means is simply that these loans, whether they're mortgages or auto loans or credit card receivables, they get pooled up and packaged together. Securitization is simply another sophisticated way to get money flowing through the Eurodollar system to make it mobile and elastic. You can essentially create solid assets out of what is otherwise toxic junk. And this is absolutely true. They do become solid assets, but it isn't foolproof. Nothing ever is, and correlation is at the center of everything. And it's not just correlation, it's also, as we know only too well, interest rates. So I'm going to be having a webinar on Tuesday, October 14th at 6 p.m. Eastern Time, where we're going to talk about the hidden truth behind interest rates, everything that you've been missing and why it is so incredibly important. There's a link in the description of this video to sign up. Again, that's Tuesday, October 14th at 6 p.m. Eastern Time. I hope to see you there. Now, how securitization works is really straightforward. A loan originator or a financial sponsor sets up a shadow bank, in a special purpose vehicle or SPV, sometimes called a special investment vehicle or SIV. These are the off-balance sheet legal structures that became somewhat famous in the 2008 crisis for the reasons I'll get to in just a second. So the sponsor finds a loan originator to, as the name implies, originate the actual loans. They do all the screening, all the paperwork, and then the sponsor provides the initial bridge financing until the bonds can be sold to the institutional public, primarily the institutional public. Once the SPV is up and running, it's also pretty simple in how it actually works. Cash flows and losses are assigned in a waterfall process. Cash that comes in for interest and principal goes immediately to the top tiers first and then waterfalls its way on down. If there isn't enough cash, then those bottom tiers, the equity and lower mezzanines, they're the ones which get stuck. That's why they are the riskiest parts of the structure, and investment rates on those bonds reflect the higher levels of risk. And they also absorb credit losses first, sort of a reverse waterfall. As loans might default, which, there's always going to be some loan defaults, they get hit to the equity piece first after taking out the over-collateralization, then work their way up into the higher tranches. But even if there are a lot of defaults, however, notice it would take an enormous amount of them to wipe out all of the junior pieces before the senior ones would ever experience a credit or cash loss. And that's how you can make a safe bond out of what really might be junk assets. So the future value or price of the senior bond really depends upon the possibility there will be a lot of defaults, a lot more than anyone expected when they put the structure together. And this is where correlation really comes in. Correlation means very simply that if we see one borrower default, there's likely to be more. How many more depends upon the factors that are driving correlation. It could be a batch of bad loans. It could be fraud, as possibly in the case of Tricolor, but most often it's just the business cycle. During healthier economic times, default rates tend to be low, and so is correlation. You head into a recession, suddenly you see more and more borrowers not just defaulting, but defaulting together, a higher level of correlation. And that's the key risk for senior ABS and MBS bonds. If correlation rises, that means there's a somewhat greater chance that defaults end up wiping out all the junior tranches, leaving that senior piece exposed to something it is not designed to be exposed to. The whole thing is engineered to have as little credit risk as possible at the senior levels. So in a period of low correlation, senior bonds are 100% no risk, no challenge. But if correlation is actually higher than everyone thought, that doesn't necessarily mean the senior bond is going to get hit, but it does mean the chances that it won't get hit are no longer strictly zero. And the higher the correlation goes, the more non-zero that possibility. And for senior bonds, which are supposed to be credit risk-free, it doesn't necessarily take a large chance of losses for the investors in those bonds or the repo cash lender who accepted those bonds as collateral to start looking at them in a more harsh light. In fact, the higher the correlation goes, the more that's going to be reflected in bond prices today. In fact, a significant increase in correlation can drive a couple points off the bond's price, even if the actual probability of that bond experiencing credit losses is relatively small. So the first question you're naturally going to be asking is, okay, we get it. Correlation is really important to these huge pieces of global finance, so where do we get it? That's the thing, though. There is no way to observe correlation. And even what we might observe today, there's no guarantee today's correlation will be tomorrow's. As I said, when the economy looks relatively healthy, if you could measure default correlation, it would be comparatively small. But if you measure it again during a downturn, not so much. So to price these ABS and MBS securities means you need some way to look at correlation today and be able to have some idea what it might be tomorrow and beyond. And the answer the marketplace has come up with, and this is really just a shortcut, is that we just assume market participants have some idea of both of those things. After all, if you're going to invest your own money in something like a senior or mezzanine ABS, you probably will have done your homework. You probably have estimated the relevant parameters, starting with default correlation, before deciding what price you might want to buy this thing at. If we assume investors have done this, and we assume all the investors have done this, then all we really need to do is find a way to extract correlation from market prices, an implied correlation much the same way as option traders get implied volatility out of the options market. And in the years leading up to the 2008 crisis, the monetary crisis, Wall Street took an academic approach to implied correlation and then just went wild with it. Now, I'm not going to mention the researcher's name because he never intended for what he called the Gaussian copula to end up being a shortcut for banks and shadow firms to think they found some secret way to robustly calculate correlation pricing. It wasn't the guy's fault. He just wrote a paper asking some questions, and Wall Street instead took it as a blueprint for securitized pricing and wrote it to self-destruction. Basically, the Gaussian copula inferred correlation from co-movements or lack of co-movement among credit default swap prices on ABS assets. If there was a lot of co-movement among the most liquid names in the ABX swaps, then the Gaussian copula assumed it must be because investors and hedgers using those credit default swaps were acting on information about credit default probabilities. Their behavior then could tell us, at least theoretical, if they were seeing a rise in credit defaults today, or maybe they were buying protection because they were thinking there'd be more credit defaults in the future. And then we could take all of that and calculate how much of each and a bunch of other probabilities that end up with an idea of correlation, except it doesn't work that way. In February 2009, Wired magazine put out an article that exposed many of the fallacies and really the fantasy behind all of this. In an article titled "The Formula That Killed Wall Street," Felix Salmon wrote, quote, "The damage was foreseeable and in fact foreseen. In 1998, way back in 98, before the guy had even invented his copula function, Paul Wilmot wrote, 'The correlations between financial quantities are notoriously unstable.' Wilmot, a quantitative finance consultant and lecturer, argued that no theory should be built on such unpredictable parameters, and he wasn't alone. During the boom years, Everybody could reel off reasons why the Gaussian copula function wasn't perfect. His approach, the guy who made it, made no allowance for unpredictability. It assumed that correlation was constant rather than something mercurial. Investment banks would regularly phone Stanford's Darrell Duffy and ask him to come in and talk to them about what exactly the copula was. And every time, Duffy would warn them that it was not suitable for use in risk management or valuation. And Wall Street didn't care because Wall Street thought it had found the holy grail to creating a correlation estimate that could then be used to mass produce these securitizations. And that was a great way to put it. Correlation is mercurial. It is the height of unpredictability. And where do most models of correlation come from these days? Yeah, you guessed it. They typically start with credit default markets and credit default swap prices. They don't use the Gaussian copula, though I think a lot of them are pretty close to it. But at the end of the day, they're the same idea expressed with more variables thrown in, because correlation is, let's face it, it's a freaking tough nut to crack. So let's bring this back to 2025 and Tricolor. And in very big picture terms, it's pretty straightforward. Yes, once you understand what correlation means and how deeply fundamental it is, the big picture perspective, like I said, is pretty simple. We've got risky parts of the credit markets which have been highly sanguine about credit losses and credit loss potential, and we all know this. So in terms of correlation, everyone has believed that it's low implied, it's low perceived correlation. The economy is strong and solid. Jay Powell said so over and over and over again, and the stock market is up, which, by the way, can be a variable used in this process. But then a relatively small subprime auto lender blows itself up for who knows what real reason, and in the bankruptcy process, trying to clean up afterward, the world gets a peek into the loan pools and finds out that maybe, just maybe, borrowers in that pool weren't as robust as everyone had thought. Maybe even they observed some higher correlation than what was being modeled yesterday. So you put that together with growing worries about a real downturn in the US, especially the labor market. What if the entire ABS markets begin to remodel correlation more and more unfavorably? That would mean, as we just went through, non-zero chances that senior bonds might end up with some losses if we go further into the downturn, which they should never have. So prices of those bonds today would have to be adjusted, especially by repo counterparties who have to take into account this non-zero possibility that is now attached to senior ABS. For any mezzanines, the pricing reaction would obviously be more acute, though by par value, the vast majority of ABS are going to be senior. Same thing with MBS. Any securitization, we're really talking about the senior pieces. Either way, the space has to be repriced for higher correlation, which is exactly what happened to mortgage bonds in 2007 and 2008. Now, I'm not saying we're seeing the same level of risk and danger here. ABS is nowhere near the scale that MBS had been leading up to the 2008 monetary crisis. However, I think we got a test of what really is a step process in correlation repricing back in April. Why shadow banks were at the center of the deflation and with so much crap collateral in the middle of it. And this is understandably how correlation gets repriced in these various cycles. It is a step process, not a continuous one, which makes for, shall we say, volatile conditions and really the potential for volatile conditions. Now, what I mean by a step process is that everyone believed the economy was fine, therefore correlation must be low. It's reflected in market prices and, importantly, credit default swaps. We fool around and rationalize ourselves into believing Jay Powell is right about the solid state of the economy. But rather than realizing he was wrong slowly over time, the realizations tend to be lumped together in market events. So the market price is low correlation, then all of a sudden, in a single step, perceived correlation jumps up as the whole system has to react to new information, really getting rid of the new information, getting rid of old assumptions. When it does, that's when you're at the point of maximum vulnerability. Again, this does not necessarily mean we're talking about a 2008, but what we are talking about is the chances of a step repricing of correlation are getting to be much, much higher and could be even a lot higher if what happens with Tricolor ends up shedding more light in an unfavorable way. The system always goes too far on the optimism side. And the post-pandemic world has seen nothing short of that. In fact, it's gone absolutely crazy in many places. That is my whole point of using the phrase forgot how to grow, to remind you that the world was not in a good place, and that assuming it was, then modeling credit parameters if the economy was great, it creates even more room for a backlash. Think about it this way. If you thought Powell and the mainstream were right about how resilient the economy is, but in reality it was forgot how to grow, even if credit defaults have been relatively small, which seem to reinforce the idea of resiliency, if in reality the economy was instead fragile, it would mean that borrowers who were making payments and just barely holding it together might get pushed too far and get pushed too far all at once. And then defaults don't just rise, they become lumpy. They rise more sharply and in highly correlated fashion. And you have to start modeling that as evidence for fragility keeps coming up, even if you don't actually see it in the marketplace today. Each time the market has to reprice, the chances for the step change getting messy and disorderly go way up. And they can spiral out of control if it goes too far. And a lot of that depends upon the willingness of the real lenders of last resort, the repo providers, to keep funding on bad collateral, which you'll notice is exactly what we talked about in the April deflationary outbreak. That's the risk of a deeper economic downturn and how it relates to these deeper shadow markets. It's not just the prospect of lost jobs, but how lost jobs might trigger the search for correlation. And in case you're wondering, yes, this is very much related to the video I did a couple days ago about hidden credit losses among shadow banks. That's the video link below. As always, thank you very much for joining me. Sign up for Eurodollar University's webinar Tuesday, October 14th, link in the description. Huge thanks to Eurodollar University members and subscribers, and until next time, take care.